For decades, the financial industry has sold us a very comforting story. We're told that investing is a guaranteed, effortless path to wealth, as long as you buy a broad index fund and never let go. This is the chart financial planners love to show you, a smooth, upward climb of the S&P 500 in nominal terms, meaning it only traps the raw dollar amount of the stock prices, without accounting for changes in purchasing power. It perfectly supports their favorite mantra, time in the market beats timing the market. But Michael Burry, the investor famous for shorting the housing market before the 2008 collapse, is looking at the exact same data and sees a trap. He recently issued a warning that the S&P 500 could face a 77% crash. To understand his math, you have to realize that the comforting narrative of endless growth relies entirely on an illusion. It ignores the silent, destructive force of inflation. When we adjust that standard S&P 500 chart for inflation, the picture changes entirely. The steady climb works into a series of highly volatile, massive valleys. Buying into the market in 1930 meant entering a 25-year dead zone. Investors watched their purchasing power remain underwater for a quarter of a century before finally clawing back to break even. If you invested in the late 1960s, you rode a roller coaster of volatility that resulted in zero real gains. You had to hold your position until the mid-1990s simply to break even. Even recently, from the year 2000 to 2010, buy-and-hold investors suffered an entire decade of sustained, grinding losses. The math is clear. Blindly holding an index fund is a gamble on history. If you enter at the wrong moment, your timeline for retirement is erased. Most retail investors assume a simple relationship. If a company makes more money, its stock price goes up. They believe the share price is a direct reflection of corporate earnings. But this equation shows how the market actually functions. Price equals earnings multiplied by the multiple. The multiple, often called the price-to-earnings or PE ratio, is simply how much investors are willing to pay for $1 of a company's profit. Look closely at the earnings variable. Over the last century, when adjusted for inflation, corporate earnings have remained surprisingly flat. They are not the engine driving massive market spikes. The real volatility comes from the multiple. When investors' sentiment shifts, this number wildly expands and shrinks, dragging the total price up and down with it. Burry's data shows that severe historical drawdowns, like the 74% collapse following 1929, were not primarily caused by falling profits. They happened because the multiple collapsed, instantly wiping out any underlying earnings growth. Watching financial news obsess over quarterly earnings is a distraction. The true force that dictates systemic market failure is multiple compression. So, what mechanical force is artificially inflating that multiple right now, and what could cause it to suddenly compress? We can see the answer in the plumbing of modern passive investing. Millions of workers automatically funnel a set percentage of every paycheck directly into S&P 500 index funds. Currently, the demographic math works in favor of the market. Younger workers are pumping roughly $3 into the reservoir for every $1 that retirees pull out. That constant net buying pressure forces the market higher. But a massive generation of baby boomers is now moving into retirement, right as the labor market slows and artificial intelligence begins threatening white-collar jobs. When that ratio inevitably flips, when only $1 flows in but retirees demand $3 out to fund their lives, the index fund has no choice but to liquidate assets. This demographic drain systematically sucks capital out of the market. It is the exact trigger for the multiple compression that causes historic crashes. This risk gauge shows Burry's math on the potential fallout. If the market multiple simply reverts to its average since 1990, the S&P 500 suffers a 32% decline. If it reverts to the longer-term historical average dating back to 1927, that triggers a 52% collapse. And if the multiple compresses to the extreme lows seen in previous secular bear markets, we hit Burry's catastrophic scenario, a 77% crash. Faced with these numbers, elite investors do not follow the retail mentality of blindly buying the dip. Warren Buffett has navigated these exact cycles before. Right now, he is hoarding a record-breaking $370 billion in cash, the highest percentage in his history. That wealth isn't sitting idle in checking accounts. It is strategically parked in short-term T-bills, government debt securities that pay a fixed interest rate, so it remains liquid and ready to deploy. For the smartest players in the market, holding cash isn't missing out on potential gains. It is building the dry powder required to buy assets at a steep discount when the multiple finally collapses. To avoid the passive investing trap, you need to track the temperature of the total market, not just individual stocks. This interface shows exactly how to monitor those macro conditions. You can do this yourself by searching for and downloading the Buffett Indicator app from the Apple App Store. If you want to move to the next tier of preparation, this is the Deep Value Intelligence platform. It provides advanced research and a personal, intelligent multi-agent designed to help you navigate extreme volatility. Go to deepvalues.ai and subscribe to access these contrarian tools. And for ongoing deep dives into market survival and investing philosophy, subscribe to our sister YouTube channel @deepvalues. Surviving the 2020s requires discarding comforting illusions for cold historical data. Realizing gains in this environment depends on positioning yourself before the crowd panics.